Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda, we'll go through our normal market update. Just a quick recap of how the earnings trades are doing. And then I'll go through our daily trades, quarterly analysis. After that, Joe will talk about, I think he's talking about some earnings stuff. And that'll be it for this week. Next week, we will be releasing the earnings plan. Just an FYI on that. So, all right, let's get started. Okay, so overall, you can see everything trip back into state 8. I think Russell was yesterday, SVX a couple of days ago. Last week, I think we had NDX and those two were QQQ were in state 6. So everything else is turned around. Hold on a second. So right now, everything back in 8. So, big picture, market pulse wise, you can see we were right around 50-50 and now we're below 30. So we're technically oversold for the market right now. Anything under 30 on the green pie is an oversold condition. A lot of movement overall. Things, we're back to 55% in state 8. So that was a pretty big drop overall. So we'll get into the market pulse here. This is overall bullish, bearish. I'm not sure why the green went away. We'll get that fixed. We can see last week we were right here where they were about to cross, and now obviously a big move up up to 72. So now we're down below that 30% mark, which is technically oversold. So I think it's a key level to watch, 30%. When you're checking your daily market pulse. We did have some spike ups here. That was last week. We were about 360. So we popped up around 600 yesterday, about 528. I doubt we'll have anything today, but nothing big. Kind of like these little shocks. We'll have to see if there's anything big that follows on. Sorry, something caught in my throat. So, little reverberations, but nothing big, nothing over 1,000 as far as there. I think the key thing is, we're technically oversold. So that historically, we can stay below there for a while, but usually can get decent rallies once we drop below that level. State 1s and 8s, you can see here, how are we last week? We had already crossed, so well above that, up to 55, not anywhere near the 70% that we got before, but obviously a pretty high period overall, in the scheme of things. So we'll just have to watch, see if these things keep trending higher, or if they start plateauing. Have to see where the top of this one is. That's just something we look for. Things start plateauing, not really moving. Big drop in state 1s, though. Obviously, 23 all the way, about 7%. Wasn't a lot there. But we did cross over here and, like a week later cross back. So obviously bearish market trends overall for the market, but, we do get some pretty strong rallies throughout this market so far. Let's just do like year to date. We get pretty strong rally here. This is the March one, real strong. Even like a little mini rally here, and then we have the big one here from June. So, yeah, we're kind of pressing, getting lower, 390 on SPY. Lows were about 365, so still pretty far off of that, but definitely it's been bearish, big bearish move. Let's take a look at the modeling here. So on the 1st of September, SPX went into state 8. It had a quick day in there for state 6, and the next day went right to 8. So our typical pattern here. We typically get down in the 1 to 2 area resistance here, and then get to our average move. Typically that's going to be 9% drop from there. I think one of the key kind of levels here to kind of watch is going to be this range right in here. You can see the 3,800. So that one is right in between 1 and 2. And that's kind of one of the key levels we've been talking about, in the range, the current SPX range is 4,200 to 3,800. So I think it'd be really a big move if it crossed below there. Definitely going to be a lot of resistance in that 1 to 2 range. Just based off of what modeling and the charts that we look at. So let's take a look at the charts. Let me clear the drawing here. Okay, so here's our 38 level, and then we got our 42. I'll push it back to here. Obviously we had a false breakout here on the 42 after this big rally up from June, and the big thing that stopped it was our 200-day MA. Obviously going forward, that's a very important thing to track, the current level of that. Obviously we're real far off of that. It's currently 4290 or 4285, so above our current range of 4200. So not really in the ball game right now. I think the key thing to watch is that 3800. We had previous lows down here, basically a false breakout, try to get back through, and then showed real strong resistance in this range here where the market just took off after that. Also below the 50-day, so that's right kind of in the middle of the range there, 4060. So I think the thing to take away from this is that 3,800 level is the key thing to watch here. Otherwise, we're kind of in a no man's land between these two areas. They're looking for news and things like that to come out to drive things. Hasn't been a lot of data in the past few days. I didn't look on the upcoming schedule, but obviously the key things to watch are, the 10-year, which has had a huge spike. We'll talk about that in a little bit, but that I think any kind of huge, like almost uncontrolled spike in like 10 years and yields is definitely going to drive the market down. Dollar strength also is a headwind as we come into earnings season, starting in a couple weeks here. So other than that, I think key things here, 3,800. Let's see if we can test that. See if the modeling, it obviously started off kind of in the right direction. See over the next week or so if we can get down into that 3,800 range or retest that lower level. Let's look at the Russell. Just went into state 8. So you can see here 1700 target 1 pretty much aligns. Our current, it's right in the middle of our range of 17 and 19. So it's right at basically 18. But pretty much lines up just how we, how the SPX is. The target 1 to 2 is the lower end of our range. So that on the SPX it's 3,800, here it's 1,700. So those two going through that would be definitely bearish for the market. I would expect a lot of resistance for SPX and for Russell if they get down into that target 1-2 range. So, on average, it's going to drop 10% in here. That's the average over 25 trading days, so a little over a month. I think that's it for that chart. We have been in kind of the 8-7, 8-7, 8-7. Popped out into 5 here, but back into 8. So, obviously, not a bullish chart by any stretch. If we could have held above 5 for any amount of time, that would have been good, but that was pretty much the top when it went into 5. So now we're back in 8. Just be careful. Anytime we're in 8s, that's when long sustained movements can happen in these stocks. Overall chart very similar. Pretty much tested at 200, failed miserably, back down, drop below the 50, and now let me pull up these. So now we're next stop down would be 1,700. And then the top of this is 19. Very similar charts. Had a bit more of a breakout of the range than SPX up here, but also failed at that 200. Quickly drop back down into the range. Now we're right in the middle, 1,800. Just overall, the bottom of these two ranges for SPX and Russell are the key things to watch going forward. If we don't get some kind of rally, which isn't out of the question. Considering we're oversold. I mean, anytime you're below 30, things can quickly turn around. Obviously, if things keep getting worse, then watch those key levels for Russell and SPX. All right, let's talk 10-year. Just pull this up real quick. In the last month, this thing's been on a tear. We're down 275. We got down in like the 2.5, 2.6 range a little before that. It's been on a straight line up, after Jackson Hole. So, if this thing keeps marching higher, it's just going to be bad for equities overall. I showed you a long time ago that basically once we get above 4% on that 10-year, it gets ugly real quick overall for equities. And I think that's something to, always keep your eye on this. This is driving everything. What the 10-year is doing. So down today, markets are up. It's almost like an inverse correlation at this point, of where we are, based off of inflation and things like that. So, all right, that was it for that. Overall expectations, creeping higher. So we're at 80% for the 21st, couple weeks out now. 80% for a 75% hike. 50 point hike is only 20%. So almost, never something out of I think the journal saying it's going to be 75. So somehow they're getting information ahead of everyone. So nothing new there. Not much change, at least. I think the big thing, the Fed balance sheet. So September is supposed to be where things start rolling off more. Um, we can see the previous week had a decent little drop, 30 billion. So it looks like things are starting to move on this front. Obviously, I think as they pull liquidity out, it's going to be bad for the markets. Obviously, less money floating around. But you can see, we're starting to get some drops here. Not a huge amount. I mean, when they, from 8,900,000,000,000 to, they pretty much got rid of 100 billion almost. So not even a huge amount, but it should start to move here. And I think, that's something, if they keep doing it, I think forget the exact numbers. I saw it. I don't recall it off the top of my head, but we should be starting to see significant runoff starting this month. These numbers, I think, come out on Thursday. Like it's a weekly number. So, keep your eye on that also. Yeah, nothing else. I mean, the news been, I showed you those crazy inflation numbers. I haven't seen too many great articles or things like that. So I'll just open it up to questions and comments at this point.
Josh, this is Dave. I have a couple of, I'd say, volatility event dates. I think people should maybe at least be thinking about. And one thing I wanted to point out was it was August monthlies, the monthly August expirations, which were like 3 days after the Jackson Hole discussions, where the market took a really big downturn from the, I don't know, 6-week run up that it was in.
Right.
And triple witch, that was the double witching day. So triple witching is this month, and that's on the 16th. So be wary of that. And the Fed meeting is like on the 20th and 21st. So it's like the next Wednesday after triple witching. And the GDP report, next GDP release is on the 29th, which is like 2 weeks after that. So we're approaching a lot of volatility events, and just be wary of those. I guess is what I'd say.
Yeah.
Maybe I'll throw a bone to Joe here. Maybe he'll talk about the Fib retracements on the SPX when he talks here. So those are, I think, we're interested too. That's all I have to say. As I'm kind of wary. If we have a run up in the next week and a half, I think I might be playing to the downside on that triple witching day.
Yeah,
we'll see. So it's high volatility is coming. So I think there might SPX premiums will be a little juicy here this month.
right. Yeah, well, I mean, the other thing, for GDP, I saw that, the one from the Fed, they had it at like 2%, and then like a week later it dropped to like 1 something. So they're thinking it's going to be negative again for this quarter. That's what they're guessing. But I think it'll be kind of borderline flat. I don't think it'll be a big negative or anything. Kind of similar to what we saw last reading. The other thing I just kind of thought of, earnings is coming up. So like you can see a lot of the times beginning of the earnings, this is the, March 15th. Like I just remember all these because we put out earnings plans. We have a like pretty strong run up like at the beginning. Here's, June 15th. And that's pretty much the bottom of this huge run. So, we're putting it out next week. Just be careful. People get really excited apparently about earnings. So that could be something that really, here's another one like 15th, 9/15. Even here, like December, kind of had a nice run up and then it turned over. But, beginning of earnings seems like, they like to run things up, based off of how expectations are. So just be careful of that.
Yeah,
If
I
you're
want to say,
bearish.
I want to say you're exactly right on that. The last GDP report that, was a technical, if you will, recession kind of thing, that was actually the mark of a big run up right after that. So,
Right.
so, of course, there was a lot of a lot of news spin on, well, it's not really recession yet. We don't know. There was, a lot of talk to try to soften that blow. I, I tend to think that the Jackson Hole, let's say, sentiment that was expressed by the Fed, it kind of like put to bed a lot of the bullishness that was going on in that last run up.
Mhm.
Oh, you never know. Anyway, just goes to show you, you get caught off guard real easy when you think things are going to happen and everybody else thinks the other way. So I got to admit, I was caught off guard by a lot the last time we were down at the first recession talk. So
Right. Well, I mean, if you think about all the things they're trying to do to slow the economy, if it's, only marginally slowing or, kind of break even on GDP, then I think it's bullish. People are like, well, they just raised the rates a ton. They're starting to decrease the balance sheet and we're not really seeing it in GDP. So maybe there is a soft land, that's kind of like
yeah,
the pie in the sky type thing. Like, oh, we'll conquer inflation and barely have a, mild recession, type thing. I think that's what the hope is, but, Powell basically saying, enemy number one is inflation, obviously is, scared some people about that. So, any kind of like minimal, like unnoteworthy GDPs, I think are bullish overall. Instead of seeing like a -3 or something. So, all right, thanks, Dave. Anyone else?
Yeah, it's Lee. I got
I
a
think,
hi. I got a question about Dave's comment on the triple witching.
Mhm.
Does triple witching generally lean bearish or generally bullish or it's flat? What does it on average do?
I don't know offhand. I think it's more like volatility type thing, because there's so many like big long expirations going at the same time.
Uh-huh.
But I don't, Dave, do you know? I haven't done any testing on it.
well, the way in this opinion, so take that for whatever it might not be worth, but I tend to look at those volatility dates and what the market has done running up to them. If it's been running up, this is what happened last time. It was run up for 2 or 3 weeks with a lot of no Fed meetings and not a lot of economic news. And okay, so people took profits. It was a profit taking opportunity for a lot of people. So if there's a big uptrend before one of those triple witching or quad witching that happens in January, then I look for a reversal is kind of what I'm looking for of a trend if it's kind of like peaking or bottoming right leading into one of those witching things. So
All
in
right.
answer to your question, I think it could go either way. It just depends on what the market has been doing. And in this market, people taking profits when they can, I think they're going to side, that's where they're going to, take their bias to. I'll take my profits if I can get them.
Okay. That
Just
helps.
my opinion, and that's not worth maybe a whole lot. So just saying.
Mhm.
No, when you say it's the lead up to it, that gives me an idea. Joe, were you saying something?
Yeah, Lee, I was just going to chime in. I've never really done any detailed research on the triple witches. I think that, by and large, it really has to do. So I'm not familiar with any trend around the triple witch. As Dave points out, sometimes, you get a little more volatility. I think it has to do with open interest around, but, there's so many instruments, there's so many strikes. Sometimes, if you get an enormous short position on the option side, where somebody's got negative gamma. To me, that's what drives the movement at expiration are the net gamma positions. And sometimes those negative gamma positions accentuate larger moves. But, one up versus down, I really don't have any feedback whatsoever.
Okay, where do you look for net gamma?
Well, I mean, again, the universe is so big. I mean, the options industry is, again, having its busiest year ever. They're trading over 40 million contracts a day for the first time in history. Open interest has been above 500 million contracts only recently, and we're getting close to that now. But I mean, you gotta be in the business of just tracking that stuff, and I don't think any of us are in that position because you've got so many instruments, so many strikes. It's damn near impossible to track.
Okay, thank you, Joe. Hey, Josh, can I ask one more question?
Sure.
Okay, can you go back to your bond where you're showing your yields and up and down and the 10-year 3.2 and change? And I need you just help me out in my understanding. I thought.
Let me pull up the other ones.
Sure.
That's the that's the rate chart. There's
Okay. Okay, well, your graph there, that's great. So I thought as money flowed into bonds, the yield, which I think is the green chart, what we're looking at, the yield goes down. And as money flows out of bonds, the yield goes up, I thought. But somehow I think I might have a disconnect because we're saying if what I said was accurate, then we're saying a lot of money is leaving bonds, looking at this graph, but it seems to me I keep hearing money's flowing into bonds. So help me out, please.
Well, I mean, yeah, there's a whole like treasury market. So, the more people bidding will bid down the prices. But I mean, outside of that, there are other things, controlling, the Fed has a big input into these yields and things like that.
Right.
But, generally the treasury market, there's institutions out there, bidding for, different, as the government debt comes due and they roll it out, or they need new ones. There's people out there bidding it. So typically, as more of these institutions, not me and you, like insurance companies or pension funds, things like that,
Right.
But they put in like bid offers, but that doesn't necessarily mean that it's going to drive the price down. But, they need it, so they may, bid higher, or depending on what their expectations are, how much they want to get filled. So really, it's about how many people are in. I mean, if there's no one in there, then obviously it goes higher. But if their expectations are that inflation, things are going up, then they may change. They're not out there lowballing. They're trying to get filled for their thing. So it's not as simple as supply and demand. It's a little more
Okay.
complex. Yeah.
And I thought I'd understood that a lot of companies in foreign countries, as their monetary system struggles, the US looks like a great place to put money. So from what I think I've been reading, understand that they're buying bonds and obviously large volumes. So
Well,
I
that's
appreciate
true.
your comments. I don't understand.
Yeah, I mean, there's a lot of dynamics, like China's sold a ton, I think Russia is like, got rid of all of it almost. But, relative to Europe, yeah, this looks really good, right?
Right.
It's kind of relativity game, relative to China, I don't know, but, relative to Russia, this is probably a terrible place. So it's all relative. But yeah, relative to Europe, I mean, that's what most people just think of off the bat. Yeah, this would be fantastic compared to them.
Right. Okay,
Yeah.
thank you.
Okay, yeah, great questions. Anyone else before we move on? All right. Yeah, you can see yield curve here too. Now the highest right now is the 1 year, or it was. It was just 3.6. So now it's 3 year, 3.5. So still inverted. Um, 10 to 2 is no longer inverted, right? No, it is, yeah, by 0.2. So we're still inverted on that, which is not good overall. So, all right, let's take a quick look. Earnings trades. So we had a vol crush trade come out last week. It was for Broadcom, AVGO. So 9-1. So, our middle strikes are 500 here. So, it's right near that area. So obviously looking pretty good profitable. I think it'd be closed out today or, yeah, probably closed out today, depending on, it's right around 5.02. So I'd assume, yeah, it's already hit like 15. So, yeah, I would take profits at any point right now. And so that's the last vol crush. We got a few bullish runners coming out. So we had a couple here, Chewy and what is that, Crowd Strike or something? I don't know that one. So these are all, a couple moderate downs, one up positively, overall still up. These still have some time, but these are pretty much the last of it overall for this quarter. So we'll see if they're closed out by next week, but overall, yeah, the whole quarter looked pretty good. So, and those numbers will be out next week. All right. Any quick questions on that? All right. So last round up here, and in the emails I send out, Dave, I couldn't open this. I don't have whatever you sent there. I don't have Thinkorswim. Under the drive, so every email we send out, the weekly one, it has with the replay, it has this folder drive. So I put it in here. It's got, since we've been tracking these from 2021. So I'm putting each quarter in there. So this is the most recent one. So it's in there if you guys want to dive into it. So we separate it into this is all trades, have to be at least 1,000. And this one, takes out those big trades, like a price line or something like that. So that you can only have a max of 2,500. This one still has a minimum of 1,000 now. So we try and level out the risk for this one. So we'll take a quick look overall. I also added in here quarter over quarter and then year over year. So I only have year over year for the bull calls. because I started the new bull puts 9/27/2021. So next quarter I'll have a year over year for the bull puts. But obviously here you could have some big losses. I think this one had like a big loss, like Priceline or something like that. But overall, still decent. On the win rates, nothing too low, except for I guess that 173. The other ones are still looking pretty good. Not great, considering, if we just pull up the chart of where we've been. Let me pull this up here. So this was the last report here. So right here. So not a great quarter overall for the market, steep drop at the beginning, then, the run up. So pretty choppy overall. That's kind of how I assess things here. The bull puts, as you can see, did much better than the bull calls here, obviously. So I guess this environment, where we're choppy sideways, then I would go with the bull puts overall, but still decent numbers quarter over quarter. Year over year, the 1 in 5, obviously got hit hard. Anything, and I was talking with Joe about this, kind of like the 3 that kind of stand out are these correlations. And, as I thought about it, these things are correlated to SPX. So if we're in a really bearish, downtrend, and they're SPX is downtrending, then these are going to get dragged down because they're highly correlated with SPX. So it actually makes pretty good sense. So I had a few ideas to try and kind of improve these strategies that I'll be testing, but overall they're still generally up, outside of these bull puts. But Keltner channel's been doing good, as well as like the deep pullback here. Here's the new ones. Obviously, not an ideal time to start on these in late July. So we'll see how they do. Obviously, they haven't had any losing trades closed out yet. So lots of open trades, books still out on them, but I think they promise, as long as we're not in these huge down markets. So similar story here with the max risk, a lot less negative numbers because we're controlling our risk, from here, on average about 1,500, like where here you can get like almost 4,000 per trade, and that's just a few trades can pull it up if you're risking 20 grand on a trade. So but pretty decent numbers. Obviously these puts, minimal amount of trades here, but we already talked about correlation kind of dragging things down, as far as the whole market coming down. But Keltner's 10% did really well here, Keltner channel. So my kind of general consensus on this is still profitable on these, kind of a mismatch, hodgepodge of a quarter. Nothing outstanding, like when we had this bull runs, these things were doing fantastic. And you can go back and look in the share drive to see when things were going higher, these things were doing great. So I'm not saying they're doing terrible. I'm just saying it's tough, given the environment. I think they're holding up pretty good overall. So I'll you guys can digest this. Feel free to ask in the coming weeks. Any questions on this now? No. All right. All right. Well, Joe, I took up a bunch of time, so I'll let you run with it here at the end.
All right, Josh, very thorough as always. Let me just, I'll grab the screen just for a couple charts, but let's see, a couple things I did want to maybe just talk about a little bit were, well, here we are. You know, as David pointed out, the good old charts and the fib retracements, pretty remarkably, all three indexes coming out of the June low, you know, to the recent mid-August high. Basically yesterday traded down to the 5/8 retracement. There's Russell, and you know, the formation down, I don't see any five waves, you know, maybe an ABC, but nothing, you know, really all pretty similar patterns. You could see almost all three of the major indexes, NDS, SPX, and RUT, right down to that 5/8 retracement. So, you know, coming out of the June 16 low. Josh talked about, you know, earnings upcoming, and, you know, obviously they drive the market. One of the economists that I've referenced before, Ed Yardeni, he came out with a new piece, which I'll post in the chat box. He came out with it just yesterday, and he's revised his S&P 500 earnings outlook down to $215 total for the year 2022, down from, I think he was down from like 225. There are a lot of sources out there, FactSet's another source. They've still got earnings north of 225 at 226. I think the range, Morgan Stanley just lowered their S&P 500 number for 2022 down to 220. So I think maybe that 215, 220 range, down from, you know, like a 230, 240 range, seems to be where we are from an earnings perspective. So just, you know, something to keep track of. Again, I'll post the Yardeni piece in the chat box. Two other things, as Josh pointed out, not a lot coming out in terms of news. It won't really be until next Tuesday and Wednesday when we get into the back into the inflation reports. So we've got CPI numbers next Tuesday, PPI numbers next Wednesday. Again, as Josh has pointed out, that 10-year has been on a total tear from basically 275 up to 330, and the markets have suffered because of it. Going back to Yardeni, something I read coming out of him a while back was that, you know, he thought that mid-June low was the significant low for the market. So I think it'll be interesting to see whether these 5/8 retracements hold, even with potentially, you know, rates continuing to go higher. You know, we'll see what the numbers show next Tuesday and Wednesday on the earnings front. And then, you know, just one other thing that's happening, and I think Powell's got a speech tomorrow. I'm not sure where he's speaking. A lot of the Fed governors, you know, are speaking publicly. You know, that's those speeches are typically very well managed, so I can't imagine there'll be many surprises. But over the next week, it'll be real interesting to see whether these recent 5/8 retracements, the 618 fibs, you know, hold at yesterday's lows. So Josh, you cover a lot more than I do, but they're my comments.
Okay, yeah, tomorrow, Powell talks at 9:10. It's on the, I think it's tomorrow. Yep.
Yeah, I think it is. So not sure, you know, where that is, but I'm guessing it wouldn't be, you know, a surprise coming out of him, but we shall see.
Okay,
And hey, Lee, if as far as the open interest, if I can track down, I mean, the OCC has a darn good website, but you know, tracking overall open interest, I think is somewhat challenging. But if I can come up with a source, I'll pass it on.
Thank you, Joe.
all right, any questions for Joe or me before we close up here?
This is Dave. I just wanted to say something following on Joe there, that the dollar is also still on a pretty good tear. And
Yeah.
it's starting to impact, I think, some of the commodities. Oil, I think, is starting to finally, crude oil, I think, has come down quite a bit. And our gasoline prices at the pump aren't coming down quite as quick, but crude oil seems to be. And I think they're attributing that to the rise of the dollar, and the strength of the dollar, which is still way up there.
Yes, it is.
Yeah.
Another headwind for corporate earnings, for the multinationals.
Yeah, I track that ETF UUP. That's like the dollar index that that's been it's been really spot on with its state ones here. Oh, it's been in state one. I think I pointed that out a couple meetings ago. Like dollars back in. So I can pull it up here.
Glad you can, because the system's been dreadfully slow for me. But I will stop sharing. All yours.
But what are the factors that would be negative or bearish for the dollar?
Well, the dollar's
What
a
would make it go down?
the dollar's a composite of like relative valuations, right?
Right.
You're comparing against the euro. Let's see, I don't know all the components of it. Let's see if it's on here.
I think commodities in general are going to get hurt with everything that trades in the dollar, which is why
Yeah.
China and Russia are trying to get away from the dollar. And like Joe just said, the multinationals that have to sell to everywhere, those other countries have to pay more so they can buy less. So
Mhm. Yeah, it's just it's all this relative comparison. So like, would you rather be in like the yen or the dollar, right? Or the euro or the pound or the dollar? Like at this point, I don't know anyone that wants to be in the euro. It's dropped significantly. So that's the main driver for the DXY.
Okay. Okay. Thank you.
All right, anyone else? Yeah, that's a hell of a state one there so far. Obviously not
Yeah,
a big mover though. But
The
you can
last
see
state
this.
one,
Yeah, yeah,
last couple have been strong, big moves.
yeah. All right. Well, thank you all. Appreciate it. Next week we'll have the earnings ready and talk to you then. Thank you.
thanks,
Everybody.
guys.